Hello everybody, I'm Peter Rigby and I'm with Adam Walker to talk about the half-year results for Informe for the 6 months to the 30th of June 2012. I know that you will be able to see a webcast of this and the presentation that we've just finished with our analysts. We've done something slightly different this year because of the Olympics and travel. We've done this via the website, via a webcast, and hopefully it went well and we've answered some questions, and you'll get a good flavour of that if you have a look at that cast. For the point of today, what we're going to do is I'm going to sort of open the batting a little bit and talk about what's happened in the first half of the year, and then we've already received a number of questions which were going to be posed live, having of course not heard or seen any of them before, and Adam and I are going to try to answer those. So firstly, I'd like to thank you all for listening and for attending. I'd like to welcome any newcomers to the group who are listening, particularly our new friends from MMPI Canada, now Informa Canada, a trade show business that we acquired at the beginning of July. So welcome to you, but welcome to anybody else who's not either met or seen us before. So how are we doing? Well, you will notice that our share price has not risen today. In fact, it's gone down. It's specifically gone down because we've seen a small decline in our revenue, which people seem to find to be weird or unexpected, despite the fact that most of the world is in recession. We don't find it that unexpected, and what we've done is ensured that as we've seen softness in revenues in very many parts of our business, some in verticals, some in geographies, that we've managed our costs accordingly. And as a result of that, despite the revenue decline, we've seen our profits increase. We've seen our earnings per share increase by nearly 3.5%, 3.4%. We've seen an improvement in our margin as we've managed the business well. We've converted 76% of our profits into cash. This time last year it was 56%, so we've done very well from that perspective. We've reduced the measure of our debt, which is how much debt we have compared to our profit, to 2.3 times. And we've actually announced a small increase in our dividend. So the dividend, for those who are shareholders, is paid in 2 tranches, an interim dividend and a second interim dividend, which is really a final dividend, and a third is paid usually at the interim stage and 2/3 are paid at the final stage. So our dividend at the interim stage will be 6p. So you can do your own sums to work out what the final dividend might be. So we're doing well. We are faced with some problems, if you like, particularly in certain vertical sectors such as banking and to some extent pharmaceuticals. We're also faced with some geographical issues. The training business in North America is weak, which has affected our events performance. The conference businesses in parts of Europe, Italy and Spain, even the stronger parts of Europe, with all due respect to Italy and Spain, Holland and Germany are seeing weakness. And as a result of that, we've taken some proactive measures. We've sold our old Austrian, Czech Republic, and Hungarian businesses to the management teams. So that's reduced the revenue in the events portfolio, and we've reduced the numbers of events that we now have and run. But we thought that was the best for those businesses and best for those management teams and the groups of people that work there. And elsewhere in the business, we've continued to look at the portfolio of products that we have and to ensure that we're retaining good products, that if their products are marginal and likely to become loss-making, then we will take appropriate action. So some of the revenue, in fact most of the revenue decline in the first half of this year compared to the first half of last year is because we've proactively reduced that revenue. We've got less product, and we've done that because we thought that the business that was left was more valuable and more profitable, and hence an improvement in our margin from 25% to 26% in round numbers. So that's where we are. I think unless Adam wants to specifically add something to that, we'll take some questions which James Garrow is going to do.
Thanks, Pete. So, Adam, in your presentation to the city, you talked about meeting expectation. What does this mean in terms of the full year profit of Informa?
The way that the city works is that there are a number of people who follow our stock, and that their job is to write an estimate and make recommendations on whether you should buy or sell or hold our stock to asset managers around the world. And they come up with their views of where our profits will be, and they are then averaged out to create a market consensus. And there are various rules in which we're not allowed to say how much profit we think we'll make, because that becomes a profit forecast, and you get tied up in all sorts of accounting issues if you do that. So you always refer to the market expectations, or expectations, rather than making a specific profit forecast. And where they sit at the moment is that we will make what's called an operating profit of 350 million for 2012. And if we were to achieve that, that would be comparable to 337 that we did in 2011. So good growth in 2012, and that will create earnings growth, earnings per share growth. And I think, as Peter's just said, although we're seeing some top-line weakness at the moment, the profitability of the group is very strong. The margins across all three of our divisions are strong, and we're anticipating growth in those margins over the full year. And the cash that is generated by those profits is very strong. So despite a strange reaction from the markets this morning, we are in very good financial strength. We're delivering what we said we would deliver. And although we've got some challenges, and there's a lot of hard work to be done by us all over the final 6 months of the year, we still feel, and we've confirmed today, that we're in line to meet those expectations.
Thank you, Adam. And Pete, the emerging markets are now 20% of group revenue. Does Informa have a target for this, and how do we compare to our competitors and peers?
Well, for our emerging markets revenues to be 20%, I think is an absolute win, because if we were to go back only 4 or 5 years, that figure would be more like 10%. So we've grown, and we've specifically grown into emerging markets, because emerging markets today is where there's some economic growth, you know, and in the rest of the 80%, which includes the United States and Europe, you know, either there's minimal growth or there's actually, you know, a decline in the economies. So it's been important for us to grow organically into emerging markets, to grow through acquisition, including in Brazil, into emerging markets, and that's a process that continues. There's no right percentage, because you know, emerging markets by their nature have risks associated with them, and there's, you know, although China may have been growing at 6, 7 or 8% in recent years, it's not tied to grow at that rate going forward. And Brazil, as an emerging market, has now got a more pedestrian growth rate compared to what it had some years ago. So the gravy train of emerging markets isn't necessarily one that's going to go on forever. And from our perspective, it's still the case that most of our products and most of our customers remain in the developed world, who need the information that we provide, who want to attend the conferences that we produce, and want to exhibit at the trade shows that we have, and want our training offerings as well. So we're not going to set a target. We're going to try to participate in the growth which is stronger in emerging markets than it is in the developed world just now. But that inevitably will change at some stage, and we'll see more growth in the emerging markets and in the developed markets, and our business is absolutely fantastically placed to take advantage of that. Now, as regards the peer group, I don't know that there is an answer to that. We've got lots of different peer groups, and within those peer groups, they've got different mixes of businesses. It's true that if you were to take a peer group as one purely with an exhibition business, mostly with an exhibition business, say, such as let's say UBM, for example, then most of their exhibition business is in high growth economies. But on the other hand, they've got a part of their business in publishing which isn't in high growth economies, and is in fact in very low growth economies in which he's struggling. So I think what I'm trying to say here, there's no direct comparison with our peer groups, although the market that Adam's just talked about likes to make those comparisons because it makes their life easier, and if you haven't got emerging markets exposure, as they call it these days, you tend to get marked down a bit. But it's interesting they use the word exposure, because in my experience, exposure has always typically been a poor thing as opposed to a good thing.
Thanks. Adam, we talk about a slight reduction in revenues across the events business. Maybe you can give some idea of the mix of the revenues growth across this part of the business.
Yeah, there's lots going on in what's described as events and training to the outside world. So within that, we have our trade show business, we have our large conference business, we have our smaller conference business, and we have our training businesses. And those of you watching will know that some of those training businesses are run alongside our conference businesses, and some of them are more corporate training, the businesses that used to be part of what was called the Performance Improvement Division. About 40% of the events and training revenues come from the large events, so the trade shows and the large conferences, and they are performing very well. Again, talking about peer group comparisons, as Peter said, there isn't a natural comparable to us, but some of our competitors have exhibition divisions, and this large events is comparable to theirs, and we are performing well in all parts of the world. We did an acquisition in Brazil this time last year, which has done very well in the last 2 months as they've run the majority of their shows. We've done very well in the first half of the year in the Middle East, when they tend to run the majority of their shows. And we're excited about the acquisition of a new team in Canada, which is predominantly a trade show business. The corporate training business, which is around about 25% of the events and training revenues, is having a tougher time. It's still largely a US revenue-based business, but its global customers often are generating from the US. So even if we're generating revenues in Europe or in Asia, they're coming from US companies with a global footprint, and therefore if the US corporate market is struggling, that's having an impact on other parts of their business. So it's been a tough time for them. They always end up with a stronger second half than the first half in the way that training budgets tend to be spent. But they're having a tough first half, and they've got a challenge in the second half ahead of them, which we desperately hope that economic conditions and employment statistics will help in terms of corporates having a bit more confidence and returning back into training. And the balance, which if I've got my maths right is 35%, is generated from the smaller conferences that we operate all around the world. So smaller conference businesses that we have in the Middle East, or we have in Australia, or we have in Brazil, as well as all of the European businesses. And lots of the smaller conference numbers are generated from businesses based in the UK, some of which are run in the UK and some of which are run elsewhere around the world. And that's mixed, and it really tends to depend on where those businesses are operating. Those that are operating in Europe are having a much harder time than those that are operating in Singapore or Brazil, or in certain sectors within Australia. So a mixed picture, but overall the division, although it hasn't grown as a whole, we believe is heading in the right direction. The strength of the brands that we have across the whole of the events and training portfolio will stand us in good stead. We have a global footprint. We manage our cost base and our profitability very, very closely, and we have a lot of confidence in this part of the business moving forward.
Thanks. And another quick one for you, Adam. The cash conversion seems to be talked a lot about. Can you explain the importance of this and how Informa is able to be consistently strong in this area?
Well, unfortunately, accountants such as myself can manipulate things like profit, but you can't manipulate cash. Cash is either there or it isn't there, and there aren't any accounting standards around cash, and that's why the market looks at cash probably more closely than it does at profits. And we have had a very, very strong historic record of turning our profits into cash, and so not using balance sheets or other means to create profits, which is only a very short-term thing. Our profits turn into our cash, and our cash is used both to sort of three predominant ways: to stimulate growth within the business, so we invest our cash back into the business in relation to investment in products or hiring people, and investment therefore into our overall workforce. We use our cash for acquisitions, which during the course of this year have been around more sort of bolt-on type acquisitions, smaller acquisitions across all three divisions. We've done acquisitions in all three areas. And thirdly, for our shareholders, which is obviously very important, that we pay a dividend. And as Peter said right at the beginning, we've announced an increase in our interim dividend with this set of results. So that's why the cash is important. And what the cash conversion is essentially is a percentage of how much of your profits you turn into cash. And the way that our seasonal cash flows work is that we generate far more cash in the second half of the year, because predominantly with the way the academic business renews its subscriptions, where we receive the vast majority of that cash in the second half. And so the first half of the year we are always below 100%, so we don't quite turn all of our profits into cash. But the percentage at this half year is 76 compared to 56 in 2011, so it shows how well we're doing from a cash perspective. And we'd expect to end the year at 100%, so that we'll have turned all of our profits into cash, and that's a very strong message for our investors.
Thanks. And Peter, so last question for you. Where do you see Informa moving over the next 3 years, and how do you see the split of the business types across the group?
I feel very comfortable with the business mix that we've got. It works out at least at the profit line of about 2/3 of our operating profits coming from publishing and 1/3 from events. And within that, you know, parts of the events business are probably more cyclical than parts of the publishing business. So those percentages could alter slightly if we start to move from, you know, the sort of low norm that we are in today to some economic growth. But you know, with a steady state of play and with the movements that we're making to make the event business more resilient, I'd expect us to retain that sort of balance within the business, to fuel some of the growth in publishing and in events through M&A. If we can find good targets across all three divisions, that is across academic information, PCI and events, but also as appropriate to push for some organic growth, understanding as it is that organic growth is most likely to come just now from the emerging markets, and it's likely to come from the developed markets. So those are all the questions we had. I hope that this has been helpful. Thank you very much for listening. I think I'd like just to close by saying that none of this great performance is possible without the contribution not only of those of you who are listening, but to everybody in the group. This is a fabulous business. You can read what you like in newspapers. You can see what people say about what their opinion of Informa, but we all know, and you should know, that we are performing really well, that we've got very valuable people, and very valuable products. We have, as we've said, a great return on investment, a really good return on invested capital. We are solid and strong from a balance sheet perspective. We have good margins, you know, and what's wrong with growing our profits between 2011 and 2012, if that's where we end up, by 7 or 8%. Pretty good, I'd say, you know, and better than most. So whilst just now we might not necessarily grow our revenues organically, we'll do okay. So thank you very much for all your support. Wish people would turn the mobile phones off. But that was Adam's alarm because he now has to go to do his 100 metres training for the first heats. So we've got to stop. Thanks a lot for listening, and hopefully see you around the business sometime in the next few months. Bye-bye.
Bye-bye.